Well, thank you for being here today. I often tell people that making your first $1 million is hard, really hard. It requires discipline, sacrifice, patience, and years of consistent saving and investing. But here's what most people don't realize. Making your second million is actually much easier than making your first. And if you understand how to capitalize on crises, it can happen much faster than you ever imagined. I'm 95 years old, and I've lived through more economic crises, market crashes, recessions, and panics than I can count. And I can tell you something with absolute certainty. Every single one of those crises created extraordinary wealth-building opportunities for people who were prepared, who stayed rational, and who had the courage to act when everyone else was paralyzed by fear. Today I'm going to share with you 3 specific ways to capitalize on crises to build your second $1 million. These aren't theories or hypotheticals. These are strategies I've used personally for over 80 years at Berkshire Hathaway. They've made us hundreds of billions of dollars. And they can work for you too if you understand the principles and have the discipline to apply them. But before we get into the strategies, let me tell you something that might surprise you. Crises are gifts. I know that sounds strange when you're watching your portfolio drop 30 or 40%, when the news is terrifying, when everyone around you is panicking. But if you've already built your first million, if you understand the fundamentals of business, and value crises are when you make the investments that create generational wealth. There's a quote I'm famous for: be fearful when others are greedy, and greedy when others are fearful. This isn't just a catchy phrase. It's the entire playbook for capitalizing on crises. When everyone else is terrified, when they're selling everything, when pessimism is at its peak, that's when the best opportunities emerge. And if you're prepared, if you have capital available, if you can stay calm, those opportunities can accelerate your journey to your second million dramatically. Let me take you through my own experiences with crises, because I think it'll help you understand how to think about them. In 1973 and 74, we had one of the worst bear markets in history. The market dropped nearly 50% over 2 years. The news was relentlessly negative. Inflation was out of control. We had an oil crisis. There was Watergate. The economy was in recession. People were convinced American business was finished. I was buying aggressively. I purchased stock in the Washington Post for about 1/4 of what I believed the business was worth. I bought other wonderful companies at prices that made no sense. Why? Because I understood that the businesses themselves hadn't changed, only the prices had. And when you can buy $1 for 50 cents, you do it regardless of what the headlines say. Those investments made during the 73 to 74 crash became some of the best I ever made. But here's the key. I could only make them because I had cash available and because I didn't panic like everyone else. In October 1987, we had Black Monday. The market dropped 22% in a single day. Trading systems were overwhelmed. People thought the financial system was collapsing. The panic was extraordinary. I didn't sell anything. In fact, I wrote an article for Forbes titled "Buy American I Am." I explained why I was optimistic about American business long term and why crashes create opportunities, not disasters. Within 2 years, the market had fully recovered and gone to new highs. The people who panicked and sold locked in permanent losses. The people who stayed calm or bought more did extraordinarily well. The dot-com bubble bursting in 2000 was fascinating because the irrationality had been so obvious. Companies with no earnings, no profits, sometimes no revenue, valued at billions of dollars. When it finally crashed, trillions in paper wealth vanished. Charlie Munger and I had stayed away from almost all of it. People criticized us for being too old-fashioned, for not understanding the new economy. Then the crash came, and suddenly our boring businesses looked pretty good. We were able to deploy capital into quality companies at much more reasonable prices once the speculation cleared out. The 2008 financial crisis was the worst since the Great Depression. Major banks collapsed. The credit markets froze. The stock market dropped 55%. Everyone was terrified that the entire financial system would collapse. And what did we do at Berkshire? We made some of the best deals of our entire history. We invested $5 billion in Goldman Sachs at very favorable terms. We invested in General Electric. We put $5 billion into Bank of America, which eventually became one of our largest and most profitable positions. Why could we do this? Because we had maintained huge cash reserves. We had liquidity when everyone else was desperate for it. We had the temperament to act when everyone else was frozen with fear. And we understood that wonderful businesses were available at once in a generation prices. Then in 2020, COVID hit. The market crashed 34% in 3 weeks, the fastest crash in history. Once again, panic was everywhere. People were certain the economy would be destroyed for years. Within 5 months, the market had recovered. Within a year, it was at all-time highs. The investors who sold in March 2020 missed one of the greatest recoveries in history. What's the common thread in all these stories? Crises create opportunities for those who are prepared. Every single time.
The details change, but the fundamental dynamic is always the same. Fear drives prices below intrinsic value, and patient investors with capital can take advantage.
Now let me explain why building your second million during crises is different from building your first million. Your first million is about brute force discipline. It's about saving aggressively, living below your means, investing consistently, and waiting patiently for compounding to work. It's hard because you're starting from scratch and the progress feels slow. But by the time you've built your first million, something magical has happened. You have capital that can work for you. You understand the principles of investing.
You've developed the discipline and temperament that separate successful investors from everyone else. And most importantly, compounding has reached a scale where it starts to accelerate dramatically.
Let me show you the mathematics. If you have $1 million and it grows at 10% annually, that's $100,000 in the first year. That's more than most people save in a year from their salary. Your money is now working as hard as you do, maybe harder. After 9 years at 10%, your $1 million has become $2 million. You built your second million without adding a penny of new capital, just by letting compounding work. But here's where crises come in. They can dramatically accelerate this process. If you can deploy capital during a crisis when wonderful businesses are trading at 40 or 50 cents on the dollar, your returns can be explosive. You're not earning 10% annually. You're potentially earning 15, 20, 25% annually on capital deployed during the crisis. This is how the wealthy become wealthier during crashes. They're not panicking and selling. They're buying aggressively. They're upgrading their portfolios. They're taking advantage of other people's fear to acquire assets at bargain prices. So let me give you the 3 specific ways to capitalize on crises to build your second million. Way number 1, buy wonderful companies at crisis prices. This is the most straightforward strategy, and it's how I've made most of my fortune. During crises, even wonderful businesses with strong competitive advantages, loyal customers, and consistent profitability see their stock prices crash along with everything else. This creates opportunities to buy quality at bargain prices. But here's what you need to understand. Not all cheap stocks are bargains. A mediocre business at a low price is still a mediocre business. What you want are wonderful businesses temporarily trading at wonderful prices. So how do you identify wonderful businesses? Let me give you the criteria I use. First, the business needs to have what Charlie and I call a moat, a durable competitive advantage that protects it from competition. This could be a powerful brand like Coca-Cola or Apple. It could be network effects. It could be cost advantages from scale. It could be high switching costs that lock in customers. The key is that the advantage is durable, meaning it'll still be there 5, 10, 20 years from now. Second, the business needs to generate strong free cash flow. Cash flow is truth. Earnings can be manipulated, but cash is real. I want to see businesses that consistently generate more cash than they consume, because that cash can be reinvested to grow the business or returned to shareholders through dividends and buybacks. Third, the business needs excellent management, people who think like owners, who allocate capital intelligently, who are honest and competent. Bad management can destroy even a great business, while good management can compound value for decades. Fourth, and this is critical, the business needs to be simple enough that I can understand it. If I can't explain how a company makes money in a few sentences, I don't invest in it. Complexity is the enemy of good decision making. When you find businesses like this, companies that meet all these criteria, and you can buy them during a crisis at 40 or 50 or 60 cents on the dollar, you make investments that can change your life. Let me give you some examples from our own portfolio. In 1988, we bought Coca-Cola stock. Now, this wasn't during a crisis, but it was when the stock had declined significantly and others were pessimistic. We paid about $1.3 billion for our position. That first year, Coca-Cola paid us about $75 million in dividends. Today, over 35 years later, Coca-Cola pays us over $700 million annually in dividends. Our dividend income has grown almost tenfold. The business kept generating cash, kept raising dividends, kept compounding value, and we just held it. Or look at American Express, we've owned it since the 1,960 seconds, but we added significantly to our position during the financial crisis when the stock crashed. It's a wonderful business with a powerful brand, a valuable closed-loop payment network, and wealthy customers. Today, it's one of our most valuable holdings. More recently, we built a huge position in Apple. Apple has the strongest brand in consumer technology, an ecosystem that locks in customers, incredible pricing power, and management that returns enormous amounts of cash to shareholders. Even though we paid what seemed like high prices, it's been extraordinarily profitable because the business quality is so high. The key in all these cases is that we bought wonderful businesses and held them for the long term. We didn't try to flip them for quick profits. We treated our stock purchases as ownership stakes in real businesses that we expected to hold for decades. During crises, these kinds of opportunities become much more common. Businesses that normally trade at fair or even expensive valuations suddenly become available at discounts of 30, 40, 50%. If you have cash ready and the courage to act, you can build wealth much faster than during normal times. Way number 2, use crises to upgrade your portfolio. This is a strategy that most people never think about, but it's incredibly powerful. During crises, you can sell mediocre holdings and use the proceeds to buy wonderful businesses at attractive prices. You're essentially upgrading your portfolio, moving from good to great. Let me explain the principle here. Time is the friend of the wonderful business and the enemy of the mediocre. If you own a mediocre business, one without strong competitive advantages, it's going to struggle to create value over time. Competition will compress margins, growth will be limited, the returns will be disappointing. But if you own a wonderful business with a durable moat, it can compound value for decades. The longer you hold it, the more valuable it becomes. This is why our favorite holding period is forever. During crises, the spread between mediocre businesses and wonderful businesses often narrows. Mediocre companies might drop 40%, but wonderful companies also drop 40%, even though their long-term prospects are vastly better. This creates an opportunity. You can sell your mediocre holdings at relatively reasonable prices and use the capital to buy wonderful businesses at temporarily depressed prices. You're improving the quality of your portfolio while prices are dislocated. Now, there's a psychological barrier here. Selling during a crisis feels terrible. Everything is down, and selling feels like giving up. But you're not selling to go to cash and hide. You're selling to redeploy into higher quality assets. You're upgrading. Let me give you a personal example. In my early days, I'd often buy statistically cheap companies, businesses trading below their book value or their liquidation value. I made some money doing this, but the returns were just okay, and it required a lot of work. Charlie Munger taught me to focus on quality instead. He showed me that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This changed everything for me. So over time, I've upgraded the Berkshire portfolio. We've moved away from mediocre businesses and concentrated more and more on wonderful businesses with durable competitive advantages. Each crisis gave us opportunities to make these upgrades at attractive prices. For individual investors, this might mean selling some of your smaller, riskier positions during a crisis and consolidating into a lower-cost S&P 500 index fund. Or it might mean selling some individual stocks that don't have strong moats and buying positions in companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble when they're temporarily on sale. The key is to be honest with yourself about what you own. If you own something mediocre, something without a durable competitive advantage, something you wouldn't want to hold for 10 years, a crisis gives you the opportunity to upgrade to something wonderful. Way number 3, build cash before the storm, deploy during the panic. This is perhaps the most important strategy of all, and it's one that requires the most discipline and foresight. Let me explain how this works. At Berkshire Hathaway, we always maintain significant cash reserves. Right now, we have over $150 billion in cash and short-term treasury bills. People sometimes criticize us for this, saying we're not putting all our money to work, that we're being too conservative. But that cash serves a critical purpose. It's optionality. It's the ability to act when opportunities arise. And the best opportunities always arise during crises, when everyone else is desperate for liquidity. Think about it this way. During crises, many investors are forced sellers. They have margin calls, they need cash to pay bills, they're panicking, or they have investment funds with redemptions. They have to sell regardless of price. This drives prices below intrinsic value. If you have cash available during these times, you're not a forced seller, you're an opportunistic buyer. You can take advantage of other people's distress. This might sound cold, but it's just the reality of how markets work. Liquidity has enormous value during crises. So how do you implement this strategy? You need to build cash reserves during good times, even though it feels like you're missing out on gains. You need to resist the temptation to be fully invested all the time. For someone with $1 million who's building toward their second million, I'd suggest keeping 10 to 20% in cash or cash equivalents during normal times. This might be $100,000 to $200,000 in money market funds or short-term treasury bills. Yes, that cash earns very little. Yes, you're giving up some potential gains during bull markets. But when the crash comes, and it always does eventually, that cash becomes incredibly valuable. You can deploy it into wonderful businesses at 40 or 50 cents on the dollar. Those investments can generate returns of 15, 20, 25% annually for years. One deployment of cash during a crisis can make up for years of sitting in cash earning nothing. This is a concept that most people don't understand because they're too focused on short-term performance. Let me give you a concrete example. During the 2008 financial crisis, we deployed billions of dollars into Goldman Sachs, General Electric, Bank of America, and other businesses. We got very favorable terms because we had cash when no one else did. Those investments have generated tens of billions of dollars in profits. If we had been fully invested before the crisis, we couldn't have made those deals. Our cash position, which looked conservative and even foolish during the bull market, turned out to be one of the most valuable assets we had. For individual investors, this means being comfortable holding significant cash even when the market is going up. It means accepting that you'll underperform during the melt-up phase of bull markets, but when the crisis comes, you'll be positioned to capitalize in ways that people who were fully invested simply can't. There's also a psychological component to this. Having cash during a crisis gives you emotional stability. You're not watching your entire net worth decline. You're not forced to sell anything. You can actually be excited about opportunities rather than terrified about losses. This emotional advantage is enormous. Now let me talk about the psychology of crisis, because understanding this is just as important as understanding the financial strategies. Crises are 90% emotional and 10% financial. The actual economic impact of most crises is temporary. Businesses recover, economies grow again, markets reach new highs. But in the moment, it feels like the world is ending. And this emotional reality is what creates the opportunities. When prices crash, people panic. They see their portfolio values declining every day. They read terrifying headlines. They hear from friends and family who are scared. Their instinct is to do something, usually to sell everything and get to safety. This is exactly the wrong response, but it's deeply human. We're wired to react to threats, to follow the herd, to avoid pain in the short term, even if it costs us in the long term. Understanding this about yourself is critical. Here's what I've learned. Temperament is more important than intelligence in investing. You don't need a high IQ to be a successful investor. You need the temperament to stay calm when others are panicking, to think independently when everyone else is following the herd, and to be patient when everyone wants instant results. During the 2008 crisis, I remember people asking me if I was scared. Of course I was concerned. But I also knew that American business would survive and thrive long term. I knew that wonderful companies were available at absurd prices. I knew that this was an opportunity, not a disaster. That perspective only comes from understanding business fundamentals and from having lived through enough crises to know that they're temporary. But you can develop this perspective even if you haven't been investing for 80 years like I have. You can study history, understand that markets always recover, remind yourself that you own businesses, not ticker symbols, and make a plan before the crisis hits that you'll stick to no matter what. The wealthy stay calm during crises because they understand this. They know that crashes are temporary dislocations, not permanent destruction. They know that fear creates opportunity. They prepared emotionally and financially to take advantage. Average investors panic because they don't understand this. They react emotionally. They make decisions based on fear rather than logic. And they lock in permanent losses by selling at the bottom. Which side of this equation do you want to be on? Now let me give you some specific guidance on how to protect yourself while capitalizing on crises. First, never use leverage or margin. I can't emphasize this enough. Leverage is how most fortunes are lost during crashes. When you borrow money to invest, you create the possibility of forced selling. Your lender can demand their money back at exactly the wrong time, forcing you to sell at the bottom. Don't let this happen to you. Second, avoid speculation entirely. During crises, you want to be buying quality, not gambling on speculative stocks. Speculative companies often go to zero during crashes. Quality companies survive and thrive. Third, stay within your circle of competence. Don't venture into areas you don't understand just because prices are low. If you don't understand the business in good times, you certainly won't understand it during a crisis. Stick to what you know. Fourth, use dollar cost averaging during the crisis. Don't try to time the exact bottom. No one can do that. Instead, deploy your cash gradually over weeks or months as the crisis unfolds. Buy a little more each time prices drop further. This removes the pressure of trying to time it perfectly. Fifth, ignore financial advisors with high fees. Most of them will just tell you to stay the course or will make emotional decisions themselves. You can implement these strategies yourself with a little discipline and education. Sixth, maintain your cash reserves even after the crisis. Don't go all in just because you found some opportunities. Keep some cash for additional opportunities that might emerge. The best time to deploy the last of your cash is often late in the crisis, not early. For those of you over 50, these principles are even more important. You have less time to recover from mistakes. Every dollar you lose is a dollar that can't compound during your remaining investing years. This means you need to be even more focused on quality. You need to maintain larger cash reserves. You need to be more conservative about position sizing, but you can still capitalize on crises. You just need to be thoughtful about how much risk you're taking. I'd suggest that investors over 50 keep 15 to 25% in cash, focus exclusively on high-quality businesses or index funds, and avoid any speculative positions entirely. Simplicity becomes even more important as you get older. Own things you understand, maintain adequate liquidity, and let compounding do the heavy lifting. Let me share what Charlie Munger would say about all this, because Charlie's wisdom on crises was profound. Charlie used to say, the big money is not in the buying and selling, but in the waiting. What he meant is that patience is the investor's greatest asset. You wait for the right pitch. You wait for a crisis when prices are attractive, then you swing hard. Charlie also believed that most of what passes for sophisticated investing is actually just sophisticated gambling. He had no patience for complexity, for trading, for trying to be clever. He believed in buying wonderful businesses at fair prices and holding them forever. During crises, Charlie would remind me to think about what the business will look like in 10 years, not what the stock price will do tomorrow. He'd say, if you're not willing to own it for 10 years, don't own it for 10 minutes. That perspective kept us focused on business fundamentals rather than market gyrations. Charlie also understood the value of inversion. Instead of asking, how do I succeed? He'd ask, how do I fail? Then he'd systematically avoid those failure modes. For crises, the failure modes are obvious: using leverage, panicking and selling at the bottom, speculating rather than investing, trying to time things perfectly. Avoid those mistakes and you'll do just fine. One more thing Charlie taught me. The first rule of compounding is to never interrupt it unnecessarily. Every time you sell during a panic, every time you switch strategies, every time you try to get clever, you interrupt your compounding. The people who get wealthy are the ones who set up a sensible strategy and then stick to it through multiple market cycles. So let me bring this all together with some final thoughts. If you've built your first million, congratulations. You've done something most people never achieve. You've developed the discipline, the temperament, and the knowledge that separates successful investors from everyone else. Now your opportunity is to accelerate your journey to your second million by capitalizing on crises. And I promise you, crises will come. They always do. The question is whether you'll be prepared to take advantage or whether you'll panic like everyone else. The three strategies I've shared today, buying wonderful companies at crisis prices, upgrading your portfolio during dislocations, and building cash before the storm to deploy during the panic. These aren't complicated, but they require discipline, patience, and courage. They require discipline to build cash during good times when it feels like you're missing out. They require patience to wait for the right opportunities rather than chasing everything that moves. And they require courage to act when everyone else is paralyzed by fear. But if you can do these things, if you can stay rational while others panic, if you can see crises as opportunities rather than disasters, you can build your second million much faster than you built your first. Remember, the stock market is a device for transferring money from the impatient to the patient. Crises accelerate this transfer. The impatient panic and sell at the bottom. The patient stay calm and buy at the bottom. Over time, this difference compounds into enormous wealth. I've been investing for over 80 years using these principles. They've made Berkshire Hathaway one of the most successful companies in history. They've made me one of the wealthiest people in the world. Not because I'm smarter than everyone else, but because I've been more disciplined and more patient. You can do the same thing. The next crisis is your opportunity. Be ready for it. Prepare now by building cash, identifying wonderful businesses you'd love to own at the right price, and strengthening your emotional discipline so you can act when everyone else freezes. Crises are gifts, though they're wrapped in fear and panic. Unwrap them carefully, take advantage thoughtfully, and let compounding do the rest. Thank you for your time today. Now go out there and prepare yourself to capitalize on the next crisis. Your second million is waiting for you. You just need the discipline, patience, and courage to seize it when the opportunity arrives. And remember, be fearful when others are greedy and greedy when others are fearful. It's not just a catchy phrase, it's the roadmap to building lasting wealth. Good luck to all of you.